Welcome back to the channel. In today's video, we're going to be talking about
Bond.
but not
James Bond.
because in the investment world, we do have our own secret agents, our own assets that we can use to help us fight the spectre, the things that we're afraid of to get started in the first place, that prevent us from going into Casino Royale and putting everything on red or on black, and basically just hoping for the best. Now, clearly when you invest, there is no man with a golden gun. So there is no guarantee that you're going to get positive returns from your investment. But there are certainly things that you can do to stack the odds in your favor. And that's what we're going to be talking about today. So if you are new to this channel, you want to learn about investing, this is definitely the place to be. Make sure that you smash the like button. I'm going to give you 3 seconds to do that right now because I do need help with the algorithm. I need people just like you to see this video, and the algorithm is heavily dependent on likes. So thank you very much for liking the video. But make sure that you subscribe and hit that notification bell. I upload every Tuesday and every Friday at 5 p.m. every single week with new videos. You'll get a notification there. And if you stick towards the end of this video, I've got a little surprise at the end for everybody. So without further ado, let's talk about
Bond.
So what is a bond? A bond is essentially debt. So it's where you as an investor lend money to either a government or to a company. So broadly, there are 2 kinds of bonds. There are corporate bonds and government bonds. And you as a retail investor are lending money to either a government or to a company. And in exchange for the money that you lend them, they will give you a rate of return that is agreed and known from the outset. And this is the beauty of a bond. It is pretty much the only way that you can invest, knowing that you're going to get a known outcome from the very start. So these things, like I say, are a secret agent there to fight the spectre, there to alleviate the fear that you might feel or the worry that you might feel that when you invest, you may be at a chance of losing money, which is always the reality. But this gives you some kind of stability, some kind of certainty, some kind of awareness that you know what the outcome is going to be when you execute or you buy that bond. So it's important to understand the fundamental difference between buying a bond and a stock in a company. And Apple is a prime example of a business that is internationally known, that you can buy shares in or stock in, but you could also go and buy one of their bonds. Now, typically companies will raise money. So they'll issue a bond when they're looking to raise money for research, for product development, so on and so forth. But whether you buy a bond or whether you buy shares in a company puts you in a different standing when it comes to your investment. I'll explain. So when you are a shareholder in Apple, then as a shareholder in Apple, because you've bought the stock, you should be eligible for dividend payments, and you will also see that your investment will grow as the Apple share price grows, which is heavily dependent on product sales, profits, dividend payments, so on and so forth. But as a shareholder, you have the unlimited potential to reap rewards according to how the company performs, because you are essentially taking risk with that company as a shareholder. That picture is very different if you're investing in an Apple bond. So an Apple bond is essentially where they want to raise money for the new development of the iPhone 13, for example, right? They want to make it 5G ready. Just as an example. Now, what they might do is they might say, right, we want to raise $50 million and we would like to pay this money back over a 3 to 5 year period. And what they will basically do is they will create a bond which will be made available to retail investors just like you and I. And in exchange for the money that we give them for this bond, they will say, okay, we will give you a return or a yield. The technical term for it in the investment world is coupon of, say, 2% per year. And that way, you know that if you were to invest £10,000 with them, for example, you know that you're getting a 2% return every single year for the next 3 to 5 years, depending on the term of the bond. Now, I'm not going to talk a lot about terms of bonds because you've got short dated bonds, you've got long dated bonds, you've also got ultra long dated bonds, but that's not really important for the context of this video right now. But typically speaking, the longer the bond term, the better the returns will be. The shorter the term, then the less the returns are likely to be. But when we look at bonds specifically, you know that you're going to get a known outcome. So i.e., in exchange for your £10,000, you are going to be getting 2% per year. So over 5 years, that's a 10% return. However, the return isn't just dictated by the length of the actual bond and how long you are lending this company money for. The strength of the company also comes into play here. And now most companies for bond purposes, and actually for any financial purposes, are all rated with a credit score. And there are a number of companies that deal specifically with rating companies and their finances in terms of financial strength. A couple of them are Standard & Poor's and Moody's. So they basically rate businesses based on their balance sheet, so on and so forth. And that's really, really important because there are different grades. You've got everything from BBB all the way up to A. If the company is listed as a BBB up to an A, then essentially they are classed as an investment grade bond. Now, for those companies, it's very, very unlikely that if you lend them money that they're going to default, because that's the biggest risk of a bond. Potentially, the company that you're going to lend the money to could not pay back their money. They could default. Typically speaking, if they're rated BBB and above, then there is very, very little chance of the company defaulting. Therefore, the return that they're going to promise you is going to be less because it's almost guaranteed that you're going to get your money back because they have a very, very, very slim chance of defaulting. Now, there are companies that won't be rated as highly as a BBB and above. They'll be rated lower, so they might be a BB, they might be a C. Bonds issued by these kind of companies are called junk bonds. And that essentially means that there is a chance that the company might default. So what you'll find is that when you have offerings from these kind of companies, the return is going to be slightly more attractive. So for example, like with Apple, you might only get 2%, but with a junk bond, they might be offering you something like 8%. It's really important to understand that with a bond, just because the rate, the coupon, or the yield is attractive doesn't necessarily mean go for it every single time. You really have to consider what level of risk you are willing to take with your bonds. So let's talk about the role of a bond. A bond's role is essentially to make sure that the sky doesn't fall and cave in on your investment. Now, in the example that I gave earlier where you buy, Apple stocks, you have unlimited growth potential with Apple stocks. You are a shareholder, you could qualify for dividends if they're paying out dividends, and you will see your investment grow as the share price in that business grows because you are a shareholder in that business. If you're buying Apple bonds, then essentially you're going to get a bond with them with a return of, say, 2%, for example. Now, if you have been following my content, I've talked from day one about the importance of having an investment goal and having a plan that goes along that. So let's just say hypothetically, your investment goal is you want to have a return every single year of 5%, and that's going to get you to your objective. What you might decide to do here is not just to use equities, because yes, whilst you can have unlimited growth potential within your equity portfolio in the stocks that you buy, you might decide that you want a little bit of security within your portfolio. And that's where bonds come in. So again, in this example, if your target is 5% and you get an Apple bond paying you 2% per year, then it means that you're almost halfway there in terms of your target return for the year. It means that you only need to get an additional 3% from your equity holdings in order to meet your goal. And that's what bonds are there to do. They're there to diversify your portfolio, to safeguard you, to prevent the sky from falling in, and to help you achieve your investment goals. Diversification is absolutely key when we look at risk management. Now, as a first-time investor, it is really, really easy to be excited about investing. And trust me, You should be excited about investing in the market and doing something that is going to add value to your future and potentially create wealth for you. But it's really, really important not just to have golden eyes, not just to be looking at this with the glee of, I can make so much money. That is often the road to ruin in a lot of stories and a lot of instances where people make wrong decisions. They don't make well enough informed decisions to safeguard themselves. So it's really important as a first-time investor that you understand these principles, you understand how you can use different asset classes or assets to ensure that you get to your investment journey. And again, in the investment course, I cover all of this. There is a chapter dedicated specifically to asset classes and asset allocations, and we talk about bonds and a number of other assets as well, which you can use within your investments to ensure that if you do have a goal of say 5% per year, you understand how you're going to map to get to that goal. It's like going from where I live right now in Shropshire to Bournemouth. If I don't know the roads that I need to go on, I use my sat nav, and my sat nav gets me there. Your asset allocation, your asset classes are almost like your sat nav. They are the tools that you use to help navigate towards your goal specifically. So the next obvious question is, well, how do I access bonds, Pete? And there are a number of ways. So if you're using the likes of Wealthify, Nutmeg, Moneybox, Plum, or anybody like that who's offering a robo-invest type proposition or via an app, then the reality is that you're going to have bonds automatically included in your portfolio. All you essentially need to do is to pick your risk appetite and everything's built for you to go into. But if you want to do this all by yourself as a DIY investor, then you can have a look at Vanguard and Fidelity as two very quick options for you to access bond funds or individual bonds. Now, it's really, really important that you understand and do a little bit more research in terms of bond funds and individual funds. I mean, it's very much like buying direct shares and a fund, right? It's very, very similar. So with an individual fund, then you're essentially going to buy an Apple share and that's all you're buying. With a bond fund, it's going to have a bond from a number of international or national companies that you can access all in one go. That work would have been done, research would have been done, would have been vetted, and by having more than one bond that you're buying in a bond fund, you're essentially diversifying your risk within that as well. If you're only going to go and buy, say, for example, Apple isn't a great example for this instance, but if you had a junk bond, for example, with a high default risk, then you don't really want to be holding those really in an individual bond. You probably want those as part of a bond fund. Now, if you're using Trading 212 or using Free Trade, you can also buy bond ETFs. But again, it's really important that you understand what is actually in them and how bond ETFs work. That might be another video that I do for you guys. So it's really important with this, whilst it's going to give you a lifeline, it's going to give you some stability within your investment strategy. It's important that you just don't approach this with you only live once, twice, that you really have a really good idea of what you're doing so that you're building something that is basically robust and will get you to your goals. So thank you so much for watching this video to this point. Like I said at the beginning, I have got a bit of a giveaway for next Friday. But the question is, I've been doing something through this video, all the way through this video. Did you catch it? What did I do? The first person that is able to highlight what I did, the theme, and how many times I did it will receive something very special from me next Friday. So guys, I'll leave it up to you. Good luck. You might have to go back and watch this over and over again just to get it, but please be specific. The theme, what I said, how many of them I put into this video. I'm sure a number of you already know what it is right now, but guys, good luck. Thank you so much for watching. I will catch you Tuesday. Have a great weekend. If you've not listened to the podcast, the artwork is right there. This week has been amazing, by the way. We're talking about Forex. I wonder why the numbers jumped, but thank you. Have a good weekend.